You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Tim Cyclesman Wood, editor of Cycles News and Views on Cyclesman.com. Welcome to the show, Tim.
Jim, thanks again for having me.
The headlines coming out of Greece, something tremendous. Tax revenue in Greece has collapsed. It's down 24% of what it usually is. 2 billion euros in the last 3 days has been withdrawn from the banks. The government denies it's going to put in capital controls to keep people from running the banks, but that probably is going to happen anyway because they don't want to support the banks who got them into this situation or the government for getting them into this situation. Is this a symptom of what's going around with the world economy overall?
Yes, I think it absolutely is. There's little doubt in my mind, and I've seen similar articles. I don't have them committed to memory to quote them, but where there are capital controls around the world about withdrawals and that sort of thing, and the bail-ins and the bailouts and all that kind of stuff, and it's all related to this massive bubble that we're in. And stocks are up hard today. I think gold is up today. And it's it's still, nothing has really happened. The market hasn't really broken, or at least not on the surface. But when you look beneath the surface, the internals are horrendous. We have seen each rally since we had a new high made in December on the industrials, and we had a new high made in early March on the industrials, and then we had another new high made back in May on the industrials. And if you look at each one of those progressive new highs, the internal strength, with breadth and a number of new highs that actually made new highs, and as the overall average moved to a new high, everything is contracting. We have the Dow Jones the transports that have not confirmed these new highs. We have a massive non-confirmation in place. And, it's like the old Dow theorist said, when the averages don't confirm, a wise man lets them alone. And that's exactly what we're seeing. Even if you look within the Dow 30, the 30 industrials, you see that the Dow Top 10, which is a top 10 dividend yielding stocks within the Dow 30, they appear to have peaked and possibly even have the 4-year cycle. When I say peak, possibly have the 4-year cycle top in place there. So not even the entire 30 industrial stocks are participating in this. And then when you look at the Dow Jones Composite, which is a composite average of the industrials, the transports, and the utilities, it looks horrible. And so what we have, it's a market that is dying a slow death. It's been propped up, of course, with the manipulation, the smoke and mirrors, and as long as it's holding up here, the illusion is that all is well. But it's not. If it was, then why would you be reading the headlines like you are? Could you see the day here when people are going to be putting a run on the local banks and the government putting a stop to it? I think that anything is possible, because this has gotten to be bigger than even I imagined. When we saw the top back in, if I can digress a little bit, back in 2000, and the call was made, and it was just a decline into a 4-year cycle low. It's not a big deal. It happens every 4 years. It has since 1896. But what I didn't realize at the time was that, we rolled over, and we've talked about this, but, there's new listeners, so let's just not hit it hard, but let's talk about it. But the 2000 top was the top in the economy. It was the top of a secular bull market that ran from 74. And then because it was the top of the economy and the secular bull market top, the Fed had to do their thing to try to re-stimulate. And I understand that. They tried to jumpstart it, ether in the carburetor, if you will, get it going. And so they created the bubble and pushed things into the new high into 2007. It only made matters worse. It collapsed. And then here we come out of this low with more of the same. All right, what has happened? The market has moved to a new high. Commodities didn't go to a new high this time. There has been somewhat of a recovery in housing, but it hasn't gone to a new high this time. The job recovery isn't there. You look at the job participation rate, it's not there. You look at the velocity of money, it's not there. Volume in the stock market's not there. And we've ended up with the longest extended 4-year cycle since the inception of the averages in 1896. And so, and then you combine that with look around globally, like with Greece and so forth. This time, it's not just a 4-year cycle top. This time, it has evolved into what I think is going to result ultimately in a massive unwinding of global proportion, because it's been made into something much larger than I ever imagined, and it's a matter of time. And like I said a million times, I know it sounds like a broken record. It's going to continue. We're seeing slowly. We're seeing the deterioration underneath the surface with the internals. We're seeing the deterioration with the number of stocks not participating in the new highs as the averages have moved to a new high. We're seeing the breakdown within the averages themselves, but it hadn't set up yet. And so it's a process. And when the process is in place with the DNA markers, like I said a million times, then I think it's done. Humpty Dumpty's fallen off the wall, and there's nothing they can do at that point. And I maintain that the statistics suggest that we go below the '09 low. Massive unwinding.
We'll have more with Tim Cyclesman Wood right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking with Tim Cyclesman Wood. You said we're about to see massive unwinding. What will be the first sign in North America that things are about to go off the road?
Well, the first sign for me, and I don't know what we're going to see. Let me say this. I don't know how it's going to look. I know that the skeletons come out of the closet after the fact. And for example, you see the DNA markers fall in place. Let's go back to the 2000 top. It happened, and that time the market just kind of flatlined. It peaked. The industrials peaked in January 2000, and the market just kind of meandered along. It didn't really go anywhere. Nothing really happened, but the setup stayed in place. And then really it was 2001 before things really got ugly and the skeletons began to come out of the closet, and then we had 9/11 and things happened. In 2000, fast forward to 2007, the top that occurred in July 2007, the DNA markers weren't in place. And I told my subscribers, I said, nope, that's not it. As stretched as this is, that's not it, because we don't have what we need to cap the advance. So we rolled over into August, turned up, and went up into October. The setup was in place then. Bada bing, bada boom, it immediately fell apart, and the skeletons came out of the closet really quickly. This time, I don't know. We get set up, and then the skeletons are going to come out of the closet. What they look like and what skeletons they are, that's a mystery. Throw a dart at a wall. I don't know. But it will happen. The other thing I want to say here is that, I've been saying this stuff and talking about how this is the most strung out, stretched, most manipulated 4-year cycle advance since the inception of the Dow Jones Industrial Average in 1896. And I'm sure somebody is sitting there thinking, this guy's been saying this, he's been saying this, and I don't believe him anymore, and whatever. And so the question then becomes, so what would it take to make you change your opinion? You can't make me change my opinion because I'm looking at the data. It is what it is. I mean, it's like looking at an elephant with the trunk cut off and trying to tell me it's not an elephant because it doesn't have a trunk. I mean, I'm looking at statistics. I'm looking at the chart. I see what I see. And it's no different than the data that was, connected with the 2007 top, the 2000 top, or any of the other 4-year cycles since 1896. The methods are no different than the ones that were used to call gold top in 2011, or the housing top, or the commodity top, or none of the other stuff. And so what the reality is real simple. It is just a strung out market that's being held up through the manipulation and through people's perception. After a while, it becomes almost a self-fulfilling prophecy in that people believe. they get trained, buy the dip, buy the dip, buy the dip. So it's not total manipulation. I mean, after a while, it kind of, like I said, there is I guess just a natural tendency of the masses to keep it going. But we are seeing that thinning. It will set up, and the statistics will unfold. So I'm not saying these things are sticking to this just to stick to it. I mean, it would be a much easier to sell people something they can see and say, oh yeah, this is a great bull market, need to be buying. It's and sell what they can see. It's a much harder sell to sell what they can't see. And so I don't say these things to be contrary. I say it because it's what the data says. And another thing, looking at that, to that point, is if you go back in history and you look at every top, be it the 2000 top, the 2007 top, the 1966 bull market top, or the 29 top, sentiment is always the highest at the tops or near the tops. As you approach the tops, I mean, it doesn't just peak like a inverted V or something like that, but sentiment is high, optimism is high, and no one ever sees the bubble. And then after it happens, people look back and say, oh, well, I guess, I can see that. And that's where we are.
Well, we'll take a look at the stock market mania going on in China, where housewives in their pajamas are now jamming the stock markets. They can't, trade because they don't have enough stockbrokers. And, I mean, they're raising insanely large amounts of money, and they wonder where they can put it.
Right. It's a trap. It's a mania. And the thing is, I was just talking to a money manager before you called. Actually, I got off the phone talking to him. He's a technical guy. He looks at this stuff, knows what he's doing. And, he's talking about how there's a vacuum under the market. There's nothing under it. When I say nothing under it, what people don't understand is that it's like a house on shifting sand. There's no foundation. There's no volume. There's no breadth. There's no new highs, a number of stocks participating. And people don't see that. They don't know what they don't know. And so just because you're printing a new high, that's not everything. And it is a massive illusion and bull trap.
One analyst told me this is a good time to take cash and buy gold, because that's probably the only thing that's going to be stable.
Well, that may be. I still see gold moving a little lower before, there are some higher degree cycle lows coming in gold, probably next year. And so as we approach those lows, I think that gold will be a play. Right now, I'm not convinced of that. In my work, I believe that's just ahead of us. But sometimes the problem people have is sometimes the place to be is just in cash and on the sidelines. It's not sexy to be on the side. Everybody wants to be invested, and that's because of the greed and the way we've been trained to be invested and be in the market for the long haul and that sort of thing. And I'm telling you, because this is the most strung out, most extended with the 4-year cycle advance since, like I said, 1896, and in light of the fact that this occurred within a secular bear market and has been pushed to new highs, I have been saying that this is the most dangerous market ever, and I believe that. And I think it's going to prove out. I have to stick with the statistics, until proven otherwise. And until we see the decline into the 4-year cycle low and those statistics are proven not to, come to pass, then I have to stick with them, because they are 100%. Let me say it another way. In every secular bear market since 1896, every 4-year cycle decline has moved below the previous 4-year cycle low 100% of the time. And a lot of people are coming out. I've heard some analysts saying that, well, the 2011 low was the 4-year cycle low. No, it was not. And, there's a lot of research behind that with the DNA markers and that sort of thing that I've covered in some of the letters, and it absolutely was not the 4-year cycle low. And even if it was, I'm not submitting to that, because I am firm that it was not. But even if it was, I haven't done the math. That's still one heck of a decline. But, we're going below the 09 low according to the statistics. I guess we'll see if that pans out.
Tim, thanks a lot for chatting with us.
Thanks, Jim.
My guest has been Tim Cyclesman Wood, editor of Cycles News and Views on cyclesman.com. You're listening to HowStreet.com Radio. Our YouTube channel is Talk Digital Network. Find us on Twitter at Talk Digital Net. Comments about the show can be sent to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com Radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com Radio is a production of HowStreet Media Incorporated.